So digging deeper into the each accounts of the balance sheet, let's go over the assets side first. So assets, by definition, are things that have future economic benefits. So this is definition number one. So these criteria must be met in order to be classified as assets, so future economic benefits. And number two, it should be owned or controlled by the entity or by the company. So especially when you're first new to accounting and you face a new type of asset or liability, some people get very confused whether this account should be classified as an asset or whether it should be classified as liability. The criteria is that if it has future economic benefits, you can classify it as assets. On the other hand, if you have a future economic liability, or if you have to give up your goods or provide services in the future, that should be classified as liabilities. We're going to look at it in just a moment. Assets are further classified into current assets and non-current assets. So assets which can be converted into cash within 1 year. So the limit is 1 year. So up to 1 year, we classify it as current assets. So very liquid assets such as cash, of course, or cash equivalents, accounts receivables and inventory. These kind of things, we're saying that it can be converted into cash within 1 year. But things like property, plant, and equipment, or intangible assets, or long-term investments and so on, those kind of assets, we find it difficult to convert it into cash within 1 year, so they're classified as non-current assets. One thing more, a very unique characteristic of the balance sheet is that total assets will always equal total liabilities plus total equity. So the left-hand side and the right-hand side of the balance sheet will always match. So it should be exactly the same in every circumstance. So total assets, by definition, is all assets owned by a company. Current assets, as mentioned, assets then can be converted into cash within 1 year. Cash and equivalents are just literally cash and very short-term financial instruments, short-term financial investments that can be converted into cash right away. So if you have a deposit in your bank, those kind of things, we can say that it is equivalent to cash. So cash and equivalents. Accounts receivables are, they're bonds, but they're bonds that have incurred from daily operations. So if you have sold something but you haven't collected cash yet, they're going to be called account receivables. Inventory, as you all probably know, are they're goods or products. They could be raw materials that you can use to sell in the future. So they're called inventory. So these three items consists, I think, the majority of current assets in most companies. There could be, of course, different assets as well, but these three should be the most important at this moment. Non-current assets, by definition, we exclude current assets from total assets. So this is the most precise definition. But anyways, it's assets that cannot be converted into cash within 1 year. Property, plant, and equipment are tangible assets. They should be tangible, and usually they're necessary for production. So things like machines, buildings, land, furniture, equipment, anything that we use in the long term for revenue generation, we call it property, plant, and equipment. They're often called PPE. So because it's so long to pronounce. Intangible assets are very similar to property, plant, and equipment. Just one difference is that they're intangible. They also carry future economic benefits. They also are used for future revenue generation. Things like patents or goodwill, copyrights, and so on. So they're treated exactly the same in terms of accounting, but the sole difference is that these are tangible and these are intangible. Moving on to the liability side, as mentioned before, they're a company's obligation to provide goods or services in the future. So, and equity, by definition, is total assets. So liabilities plus equity should always match total assets, but total equity by definition is total assets minus total liabilities. But total equity is intuitively they're by definition they're equity that belongs to the shareholders and owners. So whether they have contributed capital or whether they are profits accumulated for the equity shareholders, they're called total equity. They're sometimes called stockholders equity, shareholders equity. They're called by various names. Anyways, total liabilities, all liabilities owned by company, current liabilities, and the same with assets, current and non-current, the limit would be 1 year. So liabilities that should be obligated to be repaid within 1 year, they're classified as current liabilities. Liabilities that are not obligated within 1 year should be classified as non-current liabilities. Account payables and short-term debt are the most common items that we can see in current liabilities section. So opposite to accounts receivables, we have now accounts payables. So these are bonds incurred from operations. So they're not, payables for financing purposes, but they're rather payables for operating purposes. So they have different purposes. But if you have, raised debt, or if you have loaned money from the bank, they're called short-term debt. They have different purposes. They have financing purposes. So we classify them into accounts payables and short-term debt. So operating purposes and financing purposes, which will become important in our later lectures when we're doing corporate valuations or three-statement modeling. Non-current liabilities, again, would be total liabilities minus current liabilities. Long-term debt, so same as short-term debt, but just the obligation period is different. But anyways, long-term debt is debt for the purpose of financing. Again, it usually consists the majority of non-current liabilities. Total equity, assets minus liabilities. We're just showing two items under total equity. Capital stock that has been invested directly from the equity shareholders. So if you buy a share of Tesla, usually they're going to be recorded as capital stock. On the other hand, retained earnings are accumulated profits as a result of operations. So they have very different characteristics, but the common thing is that they're both the shareholders or the equity shareholders or the company owners portion of the company. So now we have gone through the very basics of the income statement and the balance sheet. Of course, we can also study the cash flow statement at this point, but rather than doing that, for your better understanding, we're going to first see how the three statements are related, how a certain event affects each financial statement, and we're going to call it three statement connections. So let's move on to our next part and further study accounting basics for financial modeling.